We are going to start by looking at Latchways. On Monday they reported their preliminary results. As you can see, revenue growth was quite disappointing, profit growth equally so. The explanation for this performance was Europe. I think this was probably slightly worse than the market was expecting. Everyone knew Europe was bad, but it seems to have got worse in the second half. If we jump down to the European performance, we can see that revenue fell 30% to 8.6 million. Management attributed this performance to underlying economic conditions, basically, particularly weakness in the construction market. If you look at construction indices for the EU and the Eurozone, both have been pretty weak, so this underperformance isn't particularly surprising. What is more interesting is that management quite clearly changed their view on this market probably in the second half of the year. If we jump to the interims, so this is the interim results for the year we're currently looking at, you can see that revenue growth was weak, challenging European economic backdrop. The difference was, at that point, economic activity in Europe will take time to recover, and therefore we are looking elsewhere for growth. If we jump back to the preliminary results, we can see these issues have led us to conclude that we need more direct representation in the most significant markets, process of recruiting suitable in-country sales resources. Management talk about this a bit more earlier on in the release. We have recruited a distribution sales specialist to drive our SRL and PRD sales. So what we can take from this is that management appear to have changed their view, quite possibly because the second half turned out to be a lot worse than they were expecting. I think it's difficult to really come out with a clear view whether this is good or bad. On the one hand, management are investing in resources. This shows that they're reasonably confident. And also I think that they're not afraid to really try and push things slightly. On the other hand, the risk is clearly that we are adding cost at the time when this particular market is in decline. The implication there is that management possibly think that they've lost market share. Clearly that's not a positive sign. If we jump down to North America is the smallest large division as the rest of the world, but that's quite a diverse operation, and we can see that the performance here wasn't particularly good. The main reason for this is destocking at a major customer. This is 3M. There's actually quite a lot going on here. It isn't as simple as 3M are drawing down their inventories and are going to build them back up at some point in the future. Latchways see North America as the big area for growth. At the interim results, when they said that they weren't going to grow in Europe, they said that North America was the market they were targeting. This makes sense. North America is the largest full protection market. It's also the market that's probably going to grow fastest. Economic activity is fairly strong, but, and probably more importantly, compliance with current full protection regulation is very low, particularly compared to Europe. As this compliance increases, we should see strong growth in this market. The problem is, though, is 3M are currently the major customer, and now they see Latchways coming in. A defensive maneuver that they're going to take is just going to be drawing down inventories as far as they can until they see exactly what Latchways are planning to do. Management expect this stock situation to be resolved. I think it will be. 3M are obviously a very significant company and they're going to continue making a lot of sales. At the same time, I think this is slightly unrealistic to assume as your sort of base case that things are just going to return to normal. If we move back up to the Our People section, we can see that we have made substantial investments in the sales team. The sales force is almost twice the size of a year ago. So saying that this isn't going to have some effect on the relationship with 3M seems unlikely because 3M are just going to be prudent here. The other thing that we should consider is this guy, Bill Marshall. He is head of the North American sales team. Here he is, very happy guy. What we can see here is that Bill was actually running the Western US personal safety products business for 3M. I think this is a great hire for Latchways, obviously. He has a lot of the connections with key customers in the market. He has a lot of the experience that Latchways doesn't have. At the same time, though, clearly 3M are going to be somewhat perturbed by this. If we jump back down to the North America section, we can see that management are projecting some turnaround at WinGrip. Problems in the supply chain in the aviation industry, problems with delays, that's been fairly well reported. So hopefully this situation will pick up and boost North American results. If we move on to the UK, we can see that the main factor here, revenue's up. Construction activity was improving. Management made clear that this was a trend that they were seeing at the interims. It seems to have continued through the second half. They point out that it's off a very low base, so presumably we should see some improvement of this going forward. What's interesting here though is that management talk about wind energy. We don't tend to hear a lot about this in regard to the UK. I'm not sure why that is, but it looks like it could be quite an interesting trend. Management also chose to restructure the sales team along geographic rather than product specific lines. There are a number of reasons why management probably took this decision. I think the most likely one is a change in the product mix. What this implies is possibly that WinGrip has underperformed significantly. Management talked about delays at the last interim results. Presumably these delays are turning out to be slightly more long-term than initially thought. Finally, we'll just look at the financials. I don't tend to look at these in any great detail because financials reflect what has already happened. We're slightly more interested in the future here. The most interesting thing in the income statement is this administrative expenses line, which has not grown very much, which is surprising considering the investment made in the sales force. My guess is that most of this investment is second half weighted, so we aren't going to see much here until next year. The other area to look at is the cash balance. I'm not totally convinced that management need to be running this level of cash. Last year we saw a big build up in capex, big drain on cash. This has come off this year. Really the only reason why management need to retain this level of cash is the dividend. Once you get into the situation of paying the dividend with existing levels of cash, I think it can be quite a vicious cycle. So I think this is something that investors definitely have to watch out for. The next company we're going to look at is Majestic Wine. I don't want to go into too much detail about this because I think the most important factors are assessing the CEO. A lot of this stuff is going to be based on conclusions we draw from information that isn't included in this release. The performance on sales was pretty good this year, showed much improvement over the last 1.9%, that's pretty decent. The profit performance was more disappointing. Part of this was the gross margin. We had those problems at Christmas, also distribution and admin costs rising. Both of these were, I think, well explained by the previous CEO and basically expected by the market. If we jump to the start of the interesting bit here, we get the announcement of a strategic review in progress, and we get the first indications of what exactly the new CEO is thinking about. One-off trial and learn initiatives. I believe this is something that the new CEO did at Naked Wines. So basically he's saying we'll do this at Majestic Wine. Not totally convinced by this. Creation of in-house expertise in key areas. Alright. Initial costs are expected to be $3 million in 2016, falling mostly in the first half. I was surprised the market didn't really take more fright at this. I think this is possibly quite negative news because it sounds like a lot of this are just fixed costs that are just going to keep coming out of profit. When you look at the multiple and then you start to consider whether this is peak profit, it starts to look quite negative. Jumping down, these are the areas that the new CEO has said he's going to focus on. I think, a lot of this makes sense. Invest further in staff training and retention. A lot of retailers have had really quite significant problems with this. Halfords is maybe one company that has managed to turn this around. I don't know the company that well, but I think I remember staff training was a fairly big component of the turnaround. Obviously, there were some other trends there with cycling, but it looks like staff training served them quite well. Building sustainable sales growth through personalized service. I'm not terribly convinced by this. Rebuild the supply chain to optimize on-shelf availability, reducing working capital required. Jumping down to the balance sheet, 54 million in inventories. Cost of goods sold, 219. That's about cost of sales are roughly 4 times inventory. I'm not totally convinced about this. Majestic Wine has had quite a lot of trouble with supplies in the past, and Gormley obviously has had a very different approach to that problem at Naked Wines. We'll see how this turns out. Deliver robust and scalable IT. Definitely something Majestic Wine hasn't done enough of. The old CEO was working on this. I think it makes sense to continue. Limit new store openings to 20-30 locations. I think this is an extremely big issue. The last CEO probably suffered quite a lot due to the size of his target for the absolute Majestic Wine estate. I think there are a lot of questions about exactly where the optimal scale of Majestic Wine lies, particularly if we start to think about exactly who the future customer is. The last point that really needs to be mentioned is that Gormley seems to be expecting this turnaround to take quite a long time. The last point that I wanted to look at is the e-commerce. This all looks extremely positive because this is really an area that the company should have had a handle on quite a long time ago. It's a niche retailer. It needs to be communicating with customers, so not having a single view of customers is obviously disastrous. And you need to have CRM operating well. You need to really engage with customers. So if they now have this ability, this is an area that they could do a lot better on, and this could potentially lead to much better sales numbers. APR Energy is another one that is worth a brief look. Obviously not good. I think the interesting point here is to look at exactly where this company was when it was IPO'd, what the expectations were. I remember looking at Aggreko a few years ago, and APR Energy was actually seen as one of the key threats. People believed the technology was possibly thought to be better. Of course, we really have no idea, but for some reason people thought that there was some kind of technology edge that APR Energy had. And it was all built on this contract in Libya. The only reason that they won this contract was because Aggreko weren't involved in the bidding, so when it comes up for renewal, Aggreko get involved. I think it's just interesting to really look back and see how this situation has developed. If I had to pick one factor out, it would be the reliance on the Libya contract. I mean, that wasn't a sustainable basis for the business, but the market just assumed it was. On Wednesday, we had full year results from Berkeley. Revenue reported 30% up, very strong. 39% operating profit, even stronger. What's interesting to note here is that completions were actually down and ASP was up substantially. I don't think this is a particularly sustainable trend. Prices can't keep rising forever, and completions naturally down because this is always going to be quite a supply limited market. If we jump back up to the top, we can see this number here, cash due on forward sales of about 3 billion, future anticipated gross margin of 5 billion, and we can also see here this targeting delivery of pre-tax profit over the next 3 years of 2 billion. I don't particularly like that management do this, particularly with the house builder. It's the case that we can't really value the company on a multiple. So when you start talking about big numbers, it probably looks slightly better than it actually is because you're valuing this on NAV. You've got a fixed amount of assets there that are getting run down. There isn't a terminal value to this company. So when you use big numbers, they probably mean something slightly different in this case from what they usually do. Finally, I just want to point out this net cash of 430 million, not using leverage as a house builder obviously limits your upside, but after everything that happened a few years ago, I think that everyone can be quite glad that they've taken this position, and it seems very sort of reasonable and conservative. If we look at the land bank, 37k plots, we can see that this looks pretty healthy. The completions was around 3.5k, I think. So there is a lot of land in the bank. The only real problem that I have here is that it seems difficult to make the numbers add up. This is just a projection for the next 10 years, what the discounted value is here. 5%, that's obviously an absurdly generous rate. And we get to 2.3 billion, add the 400 of cash, and you're not really anywhere near the market cap. And this is this project's going through 81% of the current land bank. I don't know, maybe they get up to 3.5k plots, and then they run through sooner and it all works out great. Maybe management assumed 475k, ASP I assume 500, still don't get there. The operating cost 150, I don't know. Management were about 130, they had some exceptionals this year, so 150 is, I don't know, maybe that's a bit harsh, but it does just seem to me that we just don't get anywhere near. And the question for me is, where exactly is this surplus of value going to come from? I mean, the way that I interpret it is that shareholders are just paying money quite far into the future. I mean, the model suggests that you're buying now, you're really paying for growth extremely far down the line that would appear to me to be quite uncertain. My conclusion here is really just that it seems to be the case that the current price is just assuming quite an uncertain future as the base case, and you really have to be a huge bull on the underlying markets to feel like this is a good price. I don't necessarily think this is a bad bet. It's just, do I know what is exactly going to happen in the London housing market for the next 12 years? No. So I think this is just a situation to avoid, really. Next company we're going to look at is KBC Advanced Tech. This is just going to be quite a short note. The interesting thing to note here is, this is kind of an oil services company. I was somewhat interested in it because it seemed like they would probably not suffer quite as much as other companies from the downturn. But the interesting point here is they won a few contracts with NOCs. I think this is quite an interesting point, whether this kind of customer is more or less exposed to the trends that we've seen develop in the oil market. So I think this is one situation to maybe follow if you're interested in that kind of thing. The final company we're going to look at is N Brown Group. I have written quite a bit about this company, so I'm going to try not to go on and on about this one. My view here is that management are basically full of it. That should be a preface to all my comments here. Numbers reported here were, I think, quite strong really. 1.5% L4L, that's good. Product revenue 4.3, good. Financial service revenue was negative, but I think, if you like this company, that's something that you definitely want to see. The changes to credit policy, they've been working through that for a long time. I think that makes perfect sense. They were seeing a lot of problems with people's credit in electricals. It's good. It makes sense just to move away from that and get rid of it. Where it starts to get slightly more questionable for me is this gross margin. Increased mix towards home and gift, yet we expect this dilution. It's this part of this famous 5 strategy in the homewares category. So this margin dilution has been expected. What we get here, greater than expected participation of strategic price investment. Now this price investment strategy has itself something of an unusual history. For most of last year, management seemed to be saying that the strategy will boost marketing investment and then sales will come through next year. Well, for one, we're here now and nothing seems to have happened. Okay. And what we see now is that there appears to be more problems with this change in strategy, which just suggests to me that it was a very haphazard thing. They did it in the last quarter of the year when everything else seemed to be going wrong. So, I mean, I don't know. it's not surprising that it seems to be going slightly wrong. And also, if we look down to the guidance, we can see that they're actually guiding now for H1 down year on year. Apparently this is, well, it says here that this is due to planned benefits of investment and restructuring. I don't fully believe all of that, but we also do hear in the CEO comments that we're becoming more aligned with typical retail phasing. I believe this refers to the change in the marketing mix towards the autumn-winter season. Logically, we would expect to see a greater weighting in the second half. What seems to be slightly more unusual, though, is that the company knew all along that this was going to be the case. The change in the marketing mix was made some time ago, so I don't know why they didn't guide for that in advance. Maybe they did, and I just don't know what I'm talking about. This just seems to be unusual that we're getting this slight change in guidance, and then there's also this talk about greater than expected strategic price investments. I mean, I'm not even totally sure about the vocabulary that they use to describe that, but it just sounds to me like we just had to cut prices more than we expected during the period. I mean, that sounds very negative to me, and when you cut guidance at the same time, I would expect them to be related. Now, of course, the factor here is full year guidance is unchanged, right? So let's just go back down here. So you've guided down for H1, that's going to be down. So logically, that means that H2 has to be up to the same degree that H1 is going down. What it sounds like to me is that things aren't quite working out as expected, and management has really just kicked the can down the road. This might seem slightly harsh, but I think it's perfectly justified because this is a management team that has not done what they said they would do. And not only that, they've actually tried to sort of rewrite history and say, oh, but this is what we've meant to do all along. And if you go back, it's quite clearly not the case. The other thing that we see is a slightly strange use of KPIs. I think this is something that we've seen before with this company. Active customer growth in the power brands crops up every now and again when it's needed. In JD Williams, we see another classic KPI, new customers. I don't understand what this one means. If volumes are up 4 and new customers up 27, I know this new customer number was something that cropped up, I think, in the Q3 of last year, maybe, with the marketing program. I mean, I don't know what it's. I mean, at the time, management said that new customers are up now, and then sales will be up next year. I draw your own conclusions from that. Simply B and Giacomo, they continue to look very strong. Double-digit revenue growth. You can't fault that. This is the famous 5 strategy in homewares here. Again, this is, it's working out very well. What I would say here, though, is Simply B and Giacomo, strong performance. Homewares, strong performance. Top line hasn't really moved much. That really speaks to exactly where we need to see growth and where we haven't seen it yet. The only other thing I think is worth mentioning is the online sales penetration, 62%. That's impressive. And 68% of new customer demand generated online. I'm not entirely sure what this means because new customer demand sounds like a slightly dubious number that doesn't really have a definition that we can be certain about. I think that shows the importance of the online channel, and it's good to see a retailer have a handle on that channel. But of course, management made the slightly strange decision to start building stores that I don't understand. I think this is a decent set of results. Q1 isn't the most important financial period for this company, but I don't think my views on management have changed very much.